Gold, the ultimate safe haven investment. In times of financial trouble, in times of uncertainty and when investors are feeling risk-averse, gold will always be a go-to. Rona O'Connell, Head of Metals Research and Forecasting, Thomson Reuters. 1. Financial trouble. Check. Uncertainty. Check. Investor risk aversion. Check. All the forces that typically drive investors to safe haven assets are in place, so why hasn't gold rallied? Many analysts believe investors are treating gold as a commodity and selling it along with industrial metals as the trade war heats up too. However, financial experts are issuing warnings about the coming economic and financial crisis and urging investors to buy gold and silver. See why the yellow metal will reclaim its status as the ultimate safe haven investment soon. What is a safe haven? In general terms, a safe haven is a place of refuge or security. During market downturns or outright crises, assets that continue to perform when others fail are considered safe havens. These assets are either uncorrelated or negatively correlated to the general market. When stocks and bonds plummet, safe havens will either retain their value or even appreciate. 3. Portfolio diversification is the practice of buying safe haven assets to protect one's wealth when traditional investment vehicles fail during times of market volatility. Why is gold a safe haven? Since gold has a very low or negative correlation with virtually all other asset classes, it is seen as a safe haven. But gold has qualities that other traditional safe havens like cash and treasury bills don't. Inflation can erode the purchasing power of dollars and paper currency-backed assets, but gold is immune to its effects. In fact, since gold is viewed as a hedge against inflation, gold prices usually rise during periods of inflation. Plus, gold offers privacy. Whereas other safe havens are usually managed by banks or financial institutions, an investor can buy and sell gold rather discreetly. Current market risk factors. Experts agree that economic and financial problems are mounting. Once the full-scale crisis erupts, these market insiders argue that gold's unique qualities will make it the only safe haven with a solution to wealth preservation. Inflation. The purchasing power of the currency is being destroyed right before your eyes, and you're just not paying attention. Mark Yusko, CEO and CIO of Morgan Creek Capital Management. Historically, when governments print more money, inflation goes up. Over the last 5 years, central banks have had the printing presses running at full speed to stimulate the economy. The losses from their monetary policy, however, far outweigh the gains. As Mark Yusko pointed out, the Fed has infused the U.S. economy with $20 trillion since 2008, but economic expansion has been the worst on record, only 1.4% real growth. In the meantime, the country has racked up the national debt and devalued its currency. The result is rising inflation. Yusko also contended that the devalued currency has caused the stock market to become overvalued and pointed to gold as the only true store of wealth. Gold is money. It's real money. For 5,000 years, an ounce of gold has bought a fine man's suit. Compared to treasuries and cash, gold has been the best hedge against inflation in the past 4 stock market crash. I'm convinced the easy money has been made. Howard Marks, co-founder and CEO chairman of Oaktree Capital Management. 5. When the same billionaire investors and hedge fund managers who predicted the last crash and backed out early are fleeing equities, it's a good warning to do the same. Investors Sam Zell and Howard Marks both think the market is overvalued and the time for caution has come. Even the Fed admits it. Current valuation ratios for households and businesses are high relative to historical benchmarks. We find that the current price-to-earnings ratio predicts approximately zero growth in real equity prices over the next 10 years. When household net worth's share of personal disposable income peaks, a stock market crash usually follows. When the next crash comes, Fed Chairman Jerome Powell won't bail out the market, predicts the Chief Executive Officer of Dow Capital Jeffrey Gundlach. Citing classic technical chart reading, Gundlach sees a massive head and shoulders bottom base pointing to a $1,000 jump in gold prices. Recession. We are seeing a significant shift in the markets. The Fed was responsible for 1,000 rally points this cycle, so we have to pay attention to what happens when the movie runs backwards. David Rosenberg, chief economist and strategist at Gluskin Sheff and Associates Inc. 6. David Rosenberg, the economist who predicted the Great Recession, is making news headlines again, warning that another one is on the way and could hit by the end of the year. The Fed's tightening of its monetary policy is one of the main reasons behind his forecast. Out of the 13 cycles that the Fed has raised interest rates since 1950, 10 of them have ended in recession. Rosenberg argues 7. Like other market analysts, he also sees the trade war as a factor driving the next economic downturn and forecast another consequence of U.S. protectionism, a weaker dollar. There's no better hedge against a weak dollar than gold, said Rosenberg. Investors turn to gold during recessions. Gold rallies have accompanied 5 out of the last 7 economic turndowns. 8. Heed expert warnings to buy gold. Experts across the financial markets, not just gold bugs, are warning investors to get out of equities and seek the safety of gold. The yellow metal may be performing like a commodity now, but soon it will be a coveted safe haven. When that time comes, the portfolio protection gold offers will come at a steep price. Why buy gold during a trade war? Investors are running for cover under haven umbrellas, as global equity indexes are crumbling under the weight of an escalating trade war. Stephen Innes, senior trader at Owen Daw: a global trade war is boiling. Fiery verbal exchanges and escalating trade tariffs between President Donald Trump and leaders of the world's other major economies continue to dominate news headlines. 1 week after President Trump left the Group of Seven, G7, summit early following a Twitter spat with French and Canadian leaders over America's increasingly tough trade policy, he slapped tariffs on Chinese imports, sparking an all-out global trade conflict. With rising inflation and widespread predictions of a recession as soon as next year, a trade war could deal a serious blow to an arguably already fragile economy. If equities are any kind of barometer of market sentiment, the country is in serious trouble. The time is now to protect your wealth with precious metals, the ultimate safe haven during financial crisis. Trade war. The possibility of a trade war with China has loomed for months. On Friday, June 15, President Trump followed through on his threats and levied a 25% tariff on $50 billion in Chinese goods, retribution for alleged international intellectual property violations. In response, China promptly slapped a 25% tax on $50 billion worth of American goods. Monday, June 18, brought a second round of tariff threats. President Trump warned China that the U.S. would impose a 10% tax on another $200 billion in products if China followed through on the retaliatory tariffs it promised on Friday. Rather than back down, China's Commerce Ministry pledged to fight back with comprehensive quantitative and qualitative measures and retaliate forcefully. With the latest clash, China joined Mexico, Canada, and the EU in a worldwide trade conflict with the U.S. Read about the latest developments in the trade disputes in this up-to-date timeline from the Peterson Institute for International Economics. Economic consequences. When you weigh the potential gains of a trade war against the economic losses, it's difficult to see how the U.S. could come out on top even if it won. Slower economic growth, reduced international sales, steeper consumer prices, and plummeting corporate profits, these are just a handful of the problems a trade conflict could bring. Such concerns are behind a recent shift in many economists' outlook for the nation. 76% view protectionist U.S. trade policies as harmful to the U.S. economy, according to a survey by the National Association for Business Economics. American industry suffers retaliatory tariffs could hurt some major American industries, energy, farm products, and automobiles. Chinese demand for soybeans, crude oil, and cars from the U.S. could drop. These are all major exports. For example, General Motors sold over 1 million more cars in China than in the U.S. in 2017, and crude oil was the fastest growing export sector. The consequences for the economy could be widespread. Demand for American goods could fall, shrinking CEO and investor confidence, and ultimately sending shocks through the stock market. Trump's former top economic advisor, Gary Cohn, has warned that a trade war could erase any corporate gains from the recent tax cuts and, worse, result in the next recession. Major infrastructure plans in the US and China are yet another consideration. President Trump's initiative to rebuild America and China's project to reconstruct the Silk Road to promote connectivity and cooperation with Eurasian countries will require extensive resources in the coming years. Taxing imports on industrial metals and other commodities could make these projects more expensive and hinder progress. American workers face job losses in the past. Trade tariffs have caused more jobs to be lost than saved. In 2002, President George W. Bush levied a 30% tax on steel imports, saving about 3,000 to 10,000 jobs in an industry that employed only 197,000 workers. The move resulted in roughly 200,000 job losses in the U.S. manufacturing sector. Then, of course, there is the impact on consumers. Today, about 330,000 Americans work directly or indirectly in the steel industry, but over 330 million Americans rely on cars every day. While duties on steel imports could save a few 100,000 jobs, they would also likely have a negative impact on the finances of the families of a few 100 million people across the country. American consumers pay higher prices. Tariffs on Chinese goods could generate revenue, but it won't come from China. It will come straight out of American pocketbooks. The Trump administration has highlighted that it's targeted mostly industrial significant technologies in its first round of tariffs against China, which took effect on July 6. The second round of 10% tariffs, which could be implemented after a public hearing in August, target computer and auto parts, as well as far more consumer goods, computers, telephones, lamps, furniture, and luggage. Companies that have to pay more for supplies like water tube boilers and steam turbines will pass those expenses on to consumers in the long run. Production costs will go up here. Consumers are going to lose and pay a higher price no matter if the goods are consumer-based or industrial supply chain products, asserted Chris Rupke, chief financial economist at the Tokyo-based global bank MUFG. U.S. stock market plunges. What kind of impact could the trade war have on the stock market? An ultimately bullish one, according to President Trump's trade advisor Peter Navarro. Investors certainly don't agree. Stocks plummeted on the U.S. and global exchanges on the Tuesday, June 19, following President Trump's initial imposition of tariffs against China. The Dow dropped into slightly negative territory for the year. Historically, trade tariffs have been bad for the stock market. The Smoot-Hawley Tariff Act of 1930 caused the stock market to plunge and exacerbated the Great Depression. In 2002, the taxes Bush levied on steel imports sent equities into decline for 8 straight months, and they didn't fully recover for another 2 years. U.S. dollar crashes. In the 40 years I've been involved in the gold market, the most important determinant of the gold price has been international confidence in the U.S. dollar, and in particular, the U.S. dollar as expressed by the U.S. 10-year Treasury, explained Rick Rule, the chief executive officer of Sprott U.S. Holdings Inc. A trade war could make foreign investors wary of purchasing U.S. debt at a time when it's swelling to astronomical levels. Factor in the predicted economic downturn, and the dollar looks especially vulnerable. Then, of course, there is the possibility that President Trump could attempt to drive the value of the dollar lower. This would make American-made products less expensive to foreign markets, diminishing the negative impact of reciprocal tariffs. The president's recent criticism of the Fed's interest rate raising policies suggests the dollar could soon become a focal point in the trade war. His words alone were enough to drive the dollar down and gold $10 higher. If the greenback falls, gold prices could jump to $1,400 in 2018, says Rule. A once-in-a-lifetime opportunity, protect your portfolio from a trade war. Investors riding one of the longest equities bull runs in history haven't had much to worry about over the last 8 years. Inflation and unemployment have remained low, and the economy has continued to expand. But the trade disputes are already starting to shock the markets. And, when a full-blown trade war erupts, many experts believe gold will see fireworks, as demand for gold will surge. History has shown trade tariffs can weigh on equities. Buying gold and silver now before the economic crisis sets in and safe haven demand skyrockets is the best way to avoid paying a steep premium to protect your portfolio. Moreover, as major infrastructure projects get underway, the entire commodities complex will likely rise. Some experts even predict the S&P Commodities Index could outperform the S&P 500 index for a number of years, providing yet another surge to gold prices.